Hello, I'm Jerry from ForexTradingMagic.com, trading the laws of charts and men. And this is lesson 4 of the series on trading pivot point or pivot point reversals. In the last lesson, lesson number 3, we covered how our stop would be below the low of the swing bar and would range anywhere to the top or high of the swing bar, which is the pivot point. Now, we would greatly improve our probability of success if we entered a long position only when price was above the pivot point. And looking at the setup that we have on this chart here, the pivot but before we get into that, we'll discuss how we determine our profit target. And we do it like this. Once a price closed above the high of the swing bar to create our pivot point and price is moving upward, where is price most likely to stop before reversing back downward, or at least stalling or bouncing? For example, on this bullish pivot upward, price rose up to a high of here before abruptly stopping and reversing back downward. But now, how could we have foretold or known with a high degree of probability that this bar would most likely at least pause or meet resistance at this level? And we do that by wherever price is. When we look at a chart, the first thing that we want to do is determine where is overhead resistance, meaning an area of price location which will abruptly stop or at least cause the up move to lose some steam or momentum. And we can recognize that by, we know for that to happen, heavy selling has to come into the market to abruptly stop an up move. Isn't that correct? That's just logical. But now, where can we reasonably predict that this high volume of selling will take place? And we can identify these locations by their appearance on the charts in specific locations and types of bars. Now, on the way up, price will continue up until it meets some resistance overhead to knock it back down, and that resistance will be in the form of selling. And in this particular situation, we would expect heavy selling to come in right around this level. We would expect selling to come in right around this level, because this is where the sellers are when we look at this chart. Now, why does this green or bullish up bar represent sellers and not buyers? Well, as we discussed in our Laws of Charts and Men series on support and resistance, that this green bar represent sellers because these are buyers who have to exit their position in the market by selling. So they are buyers when they enter the market, but at the point in time they have entered the market, now they are all potential sellers because that is the only way they can exit their position is to sell. So this is the first place where we can see recognizable selling is most likely to take place. So if we are going to set a reasonable or logical profit target, then if we enter on this bullish pivot reversal, if we enter long, then we want to place our first level of profit taking right here at the open, or it will be a range, either the open or the low of this bar, which contains the sellers. And so you can see in either case, in this particular example, the profit target has been reached. But now I know most traders have been taught that the last high and the last low are major support and resistance, which is the last high located here and the last low located at the low of the swing bar. And these points we are taught, and usually correctly so, that these levels are major support against any further down move and major resistance against any further up move. And even though this is true, however, there are hidden or not very well known support and resistance levels on the way up or down from this low or major support or high and major resistance. And trading in between this zone can be accomplished by following certain techniques that I've outlined in the laws of charts and men. And so one of the ways we also project our target, it's called a 3-bar equilibrium. And in the next lesson, lesson 5, we will talk more about 3-bar equilibrium as a confirming indicator as where we want to take our first level of profit, which we have identified as somewhere in the range of the first overhead resistance, meaning the sellers that are lurking, or potential sellers that are lurking directly overhead of the current price move and direction. So to confirm that, we can also use a technique called 3-bar equilibrium. And the next lesson, lesson 5, we will discuss 3-bar equilibrium and how it can be used to also project a profit or exit target for your trade. And this is the end of lesson 4. This is Jerry from forexmagic.com, and thank you for reading the laws of charts and men.